Hello everyone, welcome to Just Invest Today. And today we have a good video for you guys. Today we're going to be talking about two methods and strategies to guarantee you money in the stock market. And these strategies or methods are going to help you make high returns. They're going to help you focus on what you really need and what you really want in the market, because we have to do the opposite of what majority of people are doing in the market to take advantage of that. So right now we're going to get into the first method, but before we do, can you please like this video and subscribe to my channel? It's going to really benefit me. It's going to really help this channel grow, and I'm going to be providing a lot more good, strong content for you guys. So let's get into the video. So the first method, as investors, we got to exploit the people who are playing the market, the majority. So when we think about this, the majority of the market are institutional investors and retail investors. And these people are afraid of bad news, and they're pessimistic. They have short-sightedness. They do not like uncertainty in the market. And as investors, we can take advantage of this mindset that they have. These institutions, most retail investors, they need to make a quick profit. That's their focus. They just want to make money very quickly. So they're very focused on good news in the company, and they hate bad news. Bad news is the enemy for their investments, and they run away as soon as they hear a bad headline, as soon as they see anything going wrong with the company. It doesn't matter. They hate bad news. They hate bad news so much that they can't even think long term about the company. If it's a strong company and it deals with a little small problem, they're still running for the hills. Institutions are running for the hills. They do not want to deal with that. So they focus on only stuff with good news. So we can take advantage of that. When we see companies going through a little hiccup, or we see a lot of bad news in the company, but we understand the company and we know long term that this company is going to be very strong, we can take full advantage of that. Remember, guys, the market has such a herd mentality. If everyone's running for the hills because something happened with a stock, all the institutions, all the retail investors are going to start running for the hills. And that's why it's so important to have money on the side, especially when we can't find companies that are fairly valued or undervalued. It's not because we don't want to invest, it's that we can't find stuff to invest. So we have that money on the side till the time where you know it's coming. The market is going to react to any type of bad news, and their short-sightedness of the institutional investors, they're going to run for the hills. And then that's when we creep up. We put our money into these investments when they get at a fair price or undervalued price. So we got to take advantage of these institutional investors and retail investors. They succumb to the good news phenomena and the bad news phenomenon. And the good news is all about, if they see a stock going up, creeping up a little bit, that's when the momentum investors, they get into it. That's when the institutions get into it. And when they see Wall Street rating so positively about this company, there's new management, there's new blah, 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 they start jumping into these companies just relentlessly. They just get in, they just shoot up the share price over news, right? And that's how it works. But then when it comes to the bad news, they run for the hills when they hear a little bad thing about the company. It doesn't even have to be significant. It just has to be something that they see as bad for maybe like a month period, a 2-month period. They can say the earnings of the next quarter is going to be not to their expectations, and the investors, institutional investors, are running for the hill. They expect businesses just to go straight up perfectly. What business does that? There's no businesses that just go straight up perfectly like an arrow. Businesses go through ups and downs in the market, ups and downs, quarter after quarter. Stuff happens. It's about the yearly results. It's not about the quarter Like, stuff is gonna happen with a business. Business goes through those stuff, but it doesn't matter for the institutions. They're trying to make a quick profit. Soon as they hear anything bad about the company, they run for the hills. And guys, and that's when we gotta take advantage of that. If it meets our criteria of what the company is and what the company does and it's undervalued, that's when we pounce. And I guarantee you, this is what's going to make you money in the market. We take advantage of the mindset of the market, the majority of the market. And that's exactly how these institutional investors, the retail investors think. They're very short-sightedness. That's how they think, and that's how we're going to take advantage of them. So that's the first method. And a good example of this actually in the market was Alibaba. Think about it, guys. They were saying Jack Ma was missing with no research. Just because he didn't tweet, they were saying he was missing, and that was the biggest headline. They were saying they're going to nationalize Alibaba, which just never really happened in the history of the Chinese market. And when the Chinese did that, the only reason they did that because they had to bail out a company. But they're just, Wall Street is putting out this news to make you afraid. And guess what? It's crashing the stock price. Even though there was some concern with Alibaba, but the concern was overhyped, very overhyped. And that's when you guys gotta take advantage of these situations. We see these happen all the time. Like every time something happens with a company, you can see the fear in the market or the fear into that company. And the bad news phenomenon usually happens when there's a bad quarterly report. There can be some kind of destruction somewhere else in the country. Maybe if there was like a little war going on in the country, that can actually crater the price. Anything that can just hurt the company, or just not even have to hurt the company. It can be something outside of the company, not having to do with the company, and it's still crashing the stock price. So look into that, guys. Take advantage of that. When you see it, pounce on these opportunities because they do not come a lot. And when they come very fast, very quick, and you got to be knowing your timing and be very aggressive when you're doing this. So that is the first method to guaranteed results in the market. The second method and strategy, you guys have to understand that over time, the economic value of the business is going to be rewarded in the stock market. So what this means is that companies that are overvalued, it's going to be reflected in the stock market eventually. That overvalued company has to be reflected on the real economics of the company. So if the company is not earning a lot and it's overvalued already, it's eventually going to reflect what it's really earning and what's really doing in the market or in the business. And that stock that's overvalued and it's not producing is eventually going to correct itself. We don't know how long it's going to take, but it will correct itself. It has to. It just can't keep up with that production. It's going to recorrect itself. And then the opposite case can be exactly made for the same thing. Over time, when we are buying these undervalued companies or these companies that we understand it and they know they have high potential, the market over time will correct itself. The true economic of that undervalued company will come up eventually. We don't know when, but it will come. And we can take advantage of what's going to be happening. Just think about the dot-com bubble, the short-sightedness of the market. So what happened during that time? Eventually, companies that weren't even earning what they were really earning, they weren't reporting the right numbers. Those companies eventually fell down. They had to fall down eventually because they weren't keeping up with the growth rate, with what they were actually truly making in the company. There was companies selling for 50, 70, 80 PE ratios, and their earnings couldn't keep up with that. So guess what? Eventually, institutional investors realized that. They were afraid of their true earnings showing in the company, and they ran out of the company. They escaped it because they knew for a fact their earnings were not keeping up with the company. So that's what happens. And then during the dot-com bubble of the 2000s, when everything crashed, guess what happened to Berkshire Hathaway, a strong, reliable company? That company crashed with the tech companies, even though we knew Berkshire was a strong company. So it gave us that advantage. It went down to $40,000. And then guess what happened next year? If people invest into that company, it grew next year to $70,000 a share. And that's what happens when these companies that are overvalued, they're gonna have to come down eventually. They can't keep just becoming overvalued. It just doesn't happen. It's gonna revert back to the mean eventually. So we take advantage of those situations, and that all happens because of this good news phenomenon and this bad news phenomenon. So guys, these two methods are gonna help you. They're gonna get your mindset ready, get your patience, get your focus all in line. And then when this happens, this is gonna provide you the best opportunity to invest. But as long as you're patient and you're waiting. And when we're looking at this, we still gotta have to get everything down. We're still gonna be investing in strong, not competitive companies. And when I mean not competitive, they don't have the companies that we invest. We don't want them to have competitors. We want them to be the strongest, most dominant company. And that's when we know we can hold these companies for a long time and see them offer 5, 10 years into the future. And that's what we want in investing. So guys, tell me what you think about this video. Do you understand these two methods? Do you like these two methods? Are you going to do them yourself? Guys, if you like this video, please like it, subscribe to my channel, and I'll get back to you in the next video. I'm out.